Welcome to Decision Analyst Insider Series webinar on Media Marketing Mix Modeling. My name is Christy Allen. I am the Marketing Director at Decision Analyst and the moderator today. Before I introduce our presenters, I have a few notes for everyone. In the downloads section, there are some relevant case studies and white papers on marketing mix modeling. Also, please feel free to ask any questions by typing in the chat box. We will attempt to answer as many questions out as we can at the end of the presentation. If we don't answer your question during the webinar, someone will respond to your question within a day or two. Today's presenter is John Colias, Senior Vice President of Advanced Analytics at Decision Analyst. John has over 30 years of experience applying advanced metrics and models of using data of many kinds. And with that, I will hand over the presentation to John.
Thank you, Christy. So today we're going to talk about market mix modeling, and we're going to start with discussing some of the keys to success. And our agenda today includes discussing setting research objectives, building the modeling data set, which is very, very important in any market mix modeling project because the data itself is very extensive and crucial to getting a good result. And then developing the market mix model itself, estimating the return on marketing spend, which of course is the primary goal of market mix modeling, understanding for every dollar I spend on a particular type of media, how many dollars in terms of product revenue do I get back from spending that extra dollar on media. And then another objective we'll be discussing, another topic, is how to simulate a marketing plan and to explore if I make a change to my marketing plan, look at an alternative marketing plan, what happens to my product revenue. Optimizing the media mix, so not only do I generally want to be able to, with a market mix modeling project, to simulate alternative marketing plans, but to be able to use the marketing mix model to provide some insight into what is the best degree of spending for the different types of media, what's the best mix of spending, how many dollars to one media type and how many to another, in order to maximize my return in terms of revenue or units or whatever the objective is set at for. And then finally, at the end of our presentation today, we'll be giving an example. So the keys to success. First of all, understanding the requirements and the potential limitations and what to do about roadblocks. Of course, the first thing we look at is the availability of data, and we will be talking today and a little bit later about how much data is required, but basically, unless we have the data not only on sales but also on the media spend, and this is going back in time in history, and we'll talk about how much history we need to have, but the availability of the data, of course, is crucial, and that's the first thing to look at whenever we do a marketing mix modeling study. And then secondly, if we have the data, we need to have variability in that data, variability of media spend across time. So what we're looking for here is that the amount of spend increases, decreases, and if there are different channels and different products that we're looking at for the spend, that it varies across channels and across products too. So there's variability in the data. Without that kind of variability, then we're not going to be able to understand or tease out the impact of a particular spend on a particular media type on revenue from our product. Really, to do a good job of this kind of project, is strong knowledge of econometric modeling methods is required. This is a market mix modeling study is essentially an econometric modeling project. So it's really important to have someone the analyst who's working on this, to have some good experience and understand the econometric modeling methods and techniques. Then really important to this is collaborative development. To have a successful market mix modeling project, the the analyst, the supplier firm, consulting firm, the client firm needs to be working together, building on what's been done before and expanding it, improving it, and discussing all of these issues that come up in order to come up with solutions as we go along in terms of data requirements and what is desired at the back end of the marketing mix modeling study. Setting the research objectives really begins with understanding, or it's based upon the media types that are used in the past and what media types are desired in the future. So TV is very often in the marketing mix model. Radio, print, outdoor, internet, which could include banner ads, email, social media, search engine, mobile apps. All of these are different media, and what we need to have is some history on spending on all of these. The marketing objectives, typically, of course, with marketing mix modeling, we're trying to measure the return on investment by media type, these media types that are listed above. And what we typically measure for this, or the objective, is to understand if I spend, say, $100 on broadcast TV advertising, how many dollars return do I receive in terms of product revenue? That's the return on investment. I need a marketing objective is also typically in these projects to simulate alternative media plans. So if I have a certain dollars I'm spending on TV, radio, a certain dollars on print in January, in February, that defines my media plan, and what I want to be able to do, or an objective, is to be able to plug in these values and simulate what does that mean in terms of unit sales and dollar sales for my product line. These marketing objectives, of course, have their equivalent in terms of research objectives. So we also, of course, want to be able, as a research objective, measure the return on investment by media type and simulate alternative media plans. In addition, we have as a research objective typically is build a simulation tool, and not just a simulation tool, but a user-friendly simulation tool, one that is built in such a way that it is not difficult to input an alternative media plan, simulate, to review the output, to extract the output into other platforms. And then in addition to a simulation tool, just simulating alternative media plans, there's an optimization tool. It is a research objective to these types of projects. So the optimization tool is one that uses the marketing mix model in order to draw conclusions about the relative amounts of spend for these media types listed above, how many dollars for each media type by month would optimize or would maximize, for example, my product revenue. So that would be a research objective of these studies as well. Building the modeling data set is the first step in the marketing mix modeling, and also in any kind of econometric modeling exercise, and market mix modeling is essentially an econometric modeling exercise. The data set is really important. We start with what are the dimensions. And the dimensions in marketing mix modeling, of course, can be very granular or could be very high level. It's often very important to have some kind of a cross-sectional unit rather than just, for example, a national model. It could be regions, markets, trade areas, channels, brands could be the cross-sections, including competitor brands. And then the unit of time is the other dimension, and it can be months or weeks. And depending upon whether it's months or weeks, we need more or less data in terms of a minimum amount of data. Of course, more data is always better than less data. And but one of the rules of thumb that we often use, that I often use, is if we have monthly data, we want at least 5 years of monthly data. And if we can go back, if we have availability of weekly data, which means we know our marketing spend on a weekly basis, and we also, by media type, but we also can measure our sales or have history of our sales on a weekly basis, at least 2 years of weekly data. Again, these are minimums, and more history is always better. So to begin with, we have to define the variables in the modeling data set once we've got the dimensions down of the cross-sections in the time series. And of course, the dependent variable, the variable we're trying to explain, is units. And it's important to say that we prefer to have units, not currency. So unit sales, not dollar sales, is always better. So as to avoid some of the issues that arise with price changes that cause changes in revenue, for example, that can be accounted for much more smoothly if our modeling exercise is set up as predicting units and not currency. The media variables themselves, of course, are the important variables in the modeling. We're trying to understand what's the impact of increasing or decreasing media on unit sales. But these as well should be measured in terms of units. For example, not how many dollars I spend on TV advertising, but how many GRPs, gross rating points, which would be a gross rating point is a combination of reach and frequency. So if I can reach half of an audience, 50% of an audience with an advertising campaign, and I run this advertisement 3 times, then 50 times 3, 150 would be my GRP. And so it's a measure of the effort, the extent of the advertising activity. But the GRP is a measure of activity. Then there's a cost to the GRP, which can be more or less depending upon the market for the same number of GRPs of reaching the number of audience a certain number of times in a particular month or week. But in addition to the main variables, the dependent and the media variables, it's very, very important in marketing mix modeling to have control variables, because we don't, as mentioned before, when we're trying to measure the impact of a media spend on units, there's many things that impact unit sales, including macroeconomic factors, seasonality, price, and promotions. If any of us have looked at retail promotions, we would see that promotions have a huge impact on the sales themselves. And without controlling for the impact of these other things on units, then we cannot tease out or independently measure the impact of the media spend itself on sales units. And so that's why it's very, very important to have these control variables and data on these control variables going back for the same dimensions, those cross-sections, markets, for example, and the same units of time, whether it be weeks or months, going back in time so that we can build this modeling data set. We have all of the variables for all of the dimensions and all the units of time. Here we're going to get to the little bit of a technical part, as I mentioned earlier, developing the marketing mix model. So in market mix modeling, again, it's essentially the effort, as indicated on the right of this chart, is in doing an econometric model to build a demand equation. And demand equation in microeconomics, as we know, is a function of price. And so having price in there is important. And if you look at the demand line, the lower line on the right where it says price change, and as you've learned in microeconomics in your past, if we plot the demand curve, price versus units of demand, if we change the price, we can move along the demand curve, go down or up the demand curve itself. The changes in media activity actually shift the demand curve, and it shifts it up or down between whether it's more or less, and it shifts it more so for those media that have a greater impact on sales. So essentially what we're doing with market mix modeling is we're building a demand equation that has all of the variables of the demand equation, but as on the box on the right indicates, it also has marketing activity. So we're adding the marketing activity to the demand equation. And the demand equation itself can be of different functional forms. And there's advantages and disadvantages for the different functional forms. A linear form is very common. However, log linear is very common as well, and double log is very common. By log linear, we mean that the log of unit sales is a function of the media activity. And the double log, we mean the log of unit sales is a function of the log of media activity. And so there are, as I mentioned, there are advantages to disadvantages to each of these. And the log linear has certain stronger assumptions to it, and the double log has an even stronger assumption to it. The log linear has implicit in that functional form the relationship that if I change that 100 GRPs causes a certain percentage change in demand. That can be an advantageous assumption if we think it's appropriate for our market, and if we, for example, have certain limitations on the length of time series, we might want to go to a little bit stronger functional form like the log linear. The double log has an even stronger assumption behind it. And in fact, looking at a recent survey of marketing mix models that was published in a journal, a large percentage of the marketing mix models use the double log functional form. Again, all of them have their advantages and disadvantages. So doing a successful marketing mix modeling project requires that the analyst is familiar with these types of different functional forms and picks the right one that is doing justice to the data without putting too strong assumptions and letting the data drive the results. And when we do econometric modeling, as I mentioned, or market mix modeling, as I mentioned, it is essentially an econometric modeling exercise. And the area of econometric modeling typically is panel data econometrics. And there are some very big issues that come up with panel data econometrics, and one of the most important ones is called omitted variables. It's very important in a marketing mix modeling project that we gather all of those control variables that we mentioned earlier in the presentation, because according to the theory behind the econometrics, if you have an omitted variable, it can cause bias in results. So the model looks good, but we haven't accounted for the fact that we have an omitted variable, and so we've got too much ROI attributed to a media spend, or too little because we had an omitted variables problem. So really what we try to do in market mix modeling is include as many of those control variables, big things that have a big impact on demand, as possible in our modeling exercise. The other area is called endogeneity bias, and this is bias in results that's caused by certain types of correlations between your predictor variables and the omitted variables. So one of the areas that frequently happens in a marketing mix modeling is that we might not have a good average price term that's independent of the sales data. So for example, if we calculate price as a function of revenue divided by units, and so units is both in our predictor variable, the price variable, and units is in our dependent variable, the variable we're trying to explain, then we get a problem called an endogeneity bias. And there's a solution to that, fortunately, in the econometrics world, and that is called an instrumental variables approach, where we estimate a separate equation for the price term, and then use that, it's called an instrumental variable, use that in place of the price term. And so the story here is that there are issues that come up with marketing mix modeling that cause bias in results, and one needs to be familiar with the econometrics to be sure that we're accounting for the bias, we're correcting for the bias in the best possible ways. Other areas of bias are caused by serial correlation, and this is basically time series data. All time series data tends to have serial correlation, and what it means is that if my sales is high in this month, it tends to be high in the next month, or if and that's called a positive serial correlation. Very common in this kind of data. It doesn't mean that we don't get bias. It doesn't mean that we get biased results necessarily in our modeling, but it does mean that our t-statistics are biased, so that we might make wrong conclusions about whether to include an interaction term between a particular type of media mix spending and a brand, for example, and different brands. So very important to account for these kinds of modeling issues that result in panel data econometrics. We often do get to be frank, counterintuitive results in our initial modeling exercise. And then we go in and try to say, okay, where are the possibilities that we have some bias? And we look at omitted variables, endogeneity, and serial correlation. Make sure we're doing the best possible job we can, and then finalize our model. One frequently encountered modeling issue in our experience is the time series is short. We may not have the data that goes back long enough. And this is why having more cross-sections is often important when we have short time series. And so we might want to go to more granular cross-sectional definitions when we have short time series. But those are all issues one needs to consider when developing the marketing mix modeling. And the main type of modeling that we use is called mixed modeling. These types of models are available in both SAS and SPSS, for example. And they are called fixed or random effect models, and we'll talk about those in a minute. There's some other types of estimators which have been used, like a Parks estimator. Many people talk about Bayesian methods in marketing mix modeling, and in fact, there now is a procedure. In the past, you had to have specialized software to do this, and it's not common to have software that does Bayesian methods for econometric models of this kind. But SAS does have a beta version now that does hierarchical Bayes econometric modeling and builds a random effects model using hierarchical Bayesian methods. These methods are one has to be very careful with. They enable one to come up with individual cross-section models. So the Bayesian methods can be very powerful, but one needs to be very careful in applying them. And they're not common in marketing mix modeling in practice at this point yet, but many people do use them. And ad stock variables are also an important thing to account for, and we'll talk about the ad stock variable in a moment, but basically the idea that if I spend in GRPs today, it'll have an impact on today, but it'll also have an impact tomorrow, next month, and the next month, and so on, or the next week and the next week, and so on, but a diminished impact. And we'll talk about that a little bit more in a moment. So these types of econometric models, the mixed model in particular, or the fixed and random effect models, as we mentioned on the last slide, basically decompose the time series variation and the cross-section variation as depicted in this diagram with the two vehicle types. The cross-sections are the vehicle types. The time series is available for each vehicle type. And really what we want to use is primarily the time series variation. But we have multiple observation on each time series variation because we have observations on each vehicle type. And the advertising media plan hopefully was different for the different vehicles because we want that variability in the data in order to measure the result. But decomposing the time series from the cross-sectional variation is what these types of mixed models do, and it's the time series variation that is really crucial that we want to tap into and measure in order to understand the return on media spend. So as I mentioned, I promised we'd talk a little bit more about ad stock since it's an important concept in marketing mix modeling. The effect of media messages, again, lasts beyond an initial broadcast period. So as depicted in this diagram, if we have spend 100 GRPs in week 1, we may get the effect of that full 100 GRPs in that first week. In the second week, it's a diminished impact. The third week, diminished impact, and so on. After 6 weeks, we might have 50% of the impact that we had the first week. This is just an example. The actual amount of decay each week is something that we would empirically test. Hopefully our data has enough variability in it in order to empirically test whether the decay is, for example, we lose half of it in 6 weeks, half of the initial impact in 6 weeks, or whether it's 4 weeks or whatever it is. If we don't have enough data to test for that, then typically one would make an assumption about it based upon looking at literature and what has been found in other studies for your industry. And then in week 7, if we throw out another 100 GRPs, then we get the impact of that 100 GRPs plus the impact of the 100 GRPs from 7 weeks ago added to that, and that's called the ad stock. And basically, this is a stock of goodwill that's accumulated over time. And when the idea is that when this stock of goodwill in advertising, that's goodwill is created by the advertising, reaches a tipping point in the mind of consumer, it generates a sale. So advertising this week and then later on uses the previous advertising, and the combined effect may hit that tipping point and generate a sale. So one of the primary things we do in market mix modeling is to estimate a return on marketing spend. And the way we like to do this, and the way I like to explain it, is we do it via simulation. So we have our model, and we know we want to say what's the impact of a change in media spend. Again, because our modeling is based on activities, we divide that media dollars by a media cost, say a cost per GRP. And then we would input that into our simulation tool, which is based upon our estimated econometric model. We'd use the market mix model to simulate, and then the output of the market mix model would be sales units. And we'd multiply the sales units times the average revenue per unit for the product to get revenue. So we're able now to simulate how much return do we get in terms of product revenue for spending an extra dollar on a media. And we divide one by the other to get the return on marketing investment for media mix modeling. And that's essentially a process of simulation in order to do this. Another thing we want to be able to do as an objective is simulate a marketing plan, and as represented here by TV and internet and the amount of dollars. Again, these are fictitious numbers just to demonstrate what we're talking about. But the $100 of spend in January for TV and $40 for internet, this defines the marketing plan. And we simulate the marketing plan, get demand in terms of units and demand in terms of revenue as an output. So the ability to simulate this marketing plan, then tweak it and make a change in spend for a particular month for a particular type of media spend is what we would want to do, and then find out what the impact would be on demand and revenue. And that's an important ability to be able to accomplish at the end of a marketing mix modeling study. But in addition to just simulating alternative plans, we'd like to, ideally, be able to understand how to use our marketing mix modeling to optimize the media mix. And one approach, a common approach, is to use nonlinear programming algorithms. And a nonlinear programming algorithm is essentially a hill climbing algorithm. And so we have this hill that we see here in this chart for different mixes of TV spend and internet spend on the horizontal axes, X and Y axes, if you will, and they are cause or associated with a certain increase in sales revenue. And so going up, climbing this hill is what these nonlinear programming algorithms do by varying the mix of TV spend and internet spend, for example, and searching for where the summit of this hill is, where the apex, the top of the hill is, where you're getting the greatest sales revenue by the right distribution of, or right mix of spending on different types of media. So typically when we're doing this type of optimizing the media mix, we don't take the marketing mix model and just say, give us the answer, but we put certain constraints on it, like we say, here's the budget that's available. Otherwise, the nonlinear programming algorithm could just explode and try to spend, way more than is even feasible. Suggest spending way more than is even feasible. And then we have a minimum and maximum amount of budget percent of a budget we might want to allocate to a certain media type because of certain other reasons, practical reasons that we have in our company. And so we want to put constraints on those. So this is a constrained nonlinear programming exercise that we typically try to do. So we have an example today of doing this, and this screen here is a market mix model simulator optimizer. And what we can do is we can navigate through. This is built in Excel, And what I'll do for the moment is I will go ahead and make it full screen. This is built in Excel, and so we can go to the simulator, for example, and then we have buttons that we can specify various things. Typically what we do is we build in some buttons where you can save a particular scenario and you can manage it. So if I want to reload a base case, I can do so, for example, and then I can run it, and I can save this particular, as scenario as example. I can save it in a name and then pull it up again later, and when I pull it up again later, I now can pull the same inputs in later. So those are user-friendly tools that we like to build into it. And in addition, when we simulate, we also have a certain cost of GRPs that we would assume, because what we're doing when we simulate is we're taking these dollar amounts and we're dividing by the cost to again convert to a unit of activity like a GRP. So dollars of TV divided by cost per GRP would give you the GRPs, and then we simulate that way. So for example, if we wanted to simulate a budget of, let's go ahead and give an example here, and I'm going to just do a simple simulation which will carry over into the optimizer in a moment. So let's just put in some numbers in here, and let's assume that we're putting in 1.5 million of TV for January, right? And we're doing the same for maybe radio and the same for outdoor. And then I'm going to simulate, and that's 4.5 million for January. We click on the simulator button. And now we're actually implementing the marketing mix model, plugging in these numbers into the market mix model, and then we get the results. And so on the results page, we have, it's just a repeat. This is what we simulated. And then we're able to calculate a return on investment for the media type. So this is the example we mentioned earlier. Essentially what we're doing is by simulation, we're saying, okay, and these are totally fictitious numbers, so don't think that these numbers are realistic. But for example, if I spend $1 on media, on TV advertising, the return I would get is $5.42 in terms of revenue. And the way that's calculated is by essentially taking the media mix simulator and simulating with the TV advertising and without, and looking at the change in revenue, product revenue, and divided by the change in the cost of that, the media, the 1.5 million in this case, and calculating a return on media spend that way. And of course, we can get units in revenue as indicated down here below when we do that. And if we want to save this, we can always export and save it as a particular workbook that we can save under a name. But then in addition, we can go, and I'm going to copy these in order to paste them in a moment over in the Media Mix Optimizer. We can navigate to what an optimizer is, which would be a nonlinear programming hill climbing algorithm. And again, here we have different things that we can do, buttons just to make things easier. We can load a base case, for example. This loads the base case of a previous scenario. And then in addition, so the first thing we would do to run an optimization is to select what months we want to optimize over and what media we want to input, which we can do right here. And let's say we want to do exactly what we did in the simulation, 4.5 million of spend. And then we have these constraints. If I could put in 0 minimum and 100% maximum for TV, but we might not want to allow the optimizer to go to that range, so we can put in some constraints, and I had put in 0 as a minimum percent of the total 4.5 million and 30% as a maximum going to any one particular media type. And then if I wanted to change these numbers to add to 4.5 million, then I can, and we're going to optimize just for January right now, and we'll plug in the base plan that, as we did just a moment ago, defined a base plan that we just simulated, and we'll just plug in 0 for these others just as an example. And so the optimization tool, then what we can do is once we plug these in, and by the way, we can also plug in the cost that could vary by month, depending on seasonality and so forth for for 100 GRPs or whatever it is that we're optimizing. And again, the different media that are being considered here in this example are 7 types of media. And the assumption is that we've had data on all this and we were able to build our market mix model. So then we can simulate by optimizing on return on media or optimizing units. I'll just go ahead and simulate, and this will take a minute to run, and it's basically going to optimize month by month. And so what it's doing is it's doing this hill climbing algorithm, looking at the spend of 4.5 million and asking the question, what mix of dollars spend on the 7 types of media that are listed below in the month of January would maximize my return? And so this is running. It'll take another minute to run, and what I think we'll do is we'll go ahead and see if there's some questions at this point, and then I'll come right back to this in case this takes an extra minute. So one of the questions we had is, and also I have with me today Rod Carver, who's our Director of Predictive Analytics Services here. And Rod, could you go ahead and read that question?
Sure, John. One of our panelists asked about ad stock. The question is, how do you calculate ad stock effects of a multimedia campaign?
Right. So a multimedia campaign, well, preferably the...
Lynn, I was just reminded that my mic is not on,
okay.
So let me repeat that question. How do you calculate ad stock effects of a multimedia campaign?
Right. So if we mean that the campaign is TV, radio, print, and other types of media, then essentially what we want to do is have historical data on all of those campaigns, on all of those types of media, and spend on those types of media. Now, it may be that our campaign does not have some of those types of media. So the way to do what you're suggesting, and I'm going to go ahead and click OK because our optimization ended, is to simulate, use our simulator and plug in the media campaign, for example, into the simulator for all of the different types of media, simulate, and then look at the revenue, and then take them all to 0, simulate again, look at the revenue, and divide the incremental product revenue by the incremental cost, which is the sum of these numbers that we're inputting as the media plan. And so that would be a way of using the simulator to calculate the effects of the multimedia plan. And I hope I got understood your question correctly. Since our optimization just ended, I'm going to give you an example of how it looks. So initially we said, what if we put 1/3 of our 4.5 million in TV, 1/3 in radio, 33%, and 1/3 in outdoor. The optimizer, and this is totally fictitious, remember, we just made up the model coefficients in this one. This says go to the maximum that we allowed it to for TV of 30%, the maximum we allowed it to for print of 30%, but also do not do outdoor. It takes it from 33 to 1%, and it says to put some in mobile, search engine, and social media. And it's basically showing that taking the revenue for this media plan, and in fact this lift here of 0.7% would be the impact of comparing the optimal plan to the base we had plugged in a moment ago of 1/3 of the media spend for the 3 types of media, and then comparing it to the optimal, and we're getting a 0.7% lift. And this is fictitious again on revenue, 0.6% on revenue, 0.7% on net revenue, which is the extra revenue we're receiving minus the cost of the media plan itself. And some lift on units as well. And once again, an automatic output is to simulate each one of these media types one at a time, taking them to 0 and calculating what does the model imply about the return on unit revenue for a given dollar spent on the media type. And here's the actual amount of dollars it says to spend in the different plans. So that's an example of applying a nonlinear programming algorithm in order to optimize a media plan and using a marketing mix model to do so.
We have an additional question about ad stock. and it's about different types of advertising. Do you account for different ad stock effects from promotional type ads as opposed to equity-oriented ads?
That's a very good question, and it could very well be that the ad stock result is very different for those two, and it also and so if we have historical data that is able to separate out the GRPs for the equity ads versus the other type promotional ads, then we can then build a model where we have separate model coefficients or separate return on investment that we can calculate by simulation for the two types of, say, of advertising. And if that's the case, then these 7 types of media that we have listed here, one of them would be an equity ad versus another one which would be, now that depends upon having the historical data broken out that way in order to measure that impact when we get to the end of the marketing mix modeling project. But that is a very good question. It also brings up another issue, which is that brand building over time through advertising is something that's very difficult to measure with marketing mix modeling. We're typically measuring a short-run impact. We spend 100 GRPs and what happens in the next few months. But as we all know, the image of the brand can be improved over time through advertising, and those kinds of impacts are very difficult to tease out with marketing mix modeling. So we're talking about more of these short-term advertising effects.
We have one additional question, and this one is about the computer that is necessary to run the simulator. What kind of specs does that computer need? Does it have to be a high-powered machine, or will most any computer run that simulator?
Yeah, great question. So what I'm using and what I use here just now is just a particular laptop. Nothing unusual about it. The simulator is built in Excel, although in order to do the optimization part, the nonlinear programming algorithm, we used a Python module. So Python was installed on my laptop, and two of the modules that come with Python, one of them is the nonlinear programming algorithm, have to be installed on the laptop as well. And it basically, you know, I don't have an unusual laptop in any sense of the word. It was taking about 25% of my memory to be running, and I'm able to actually run it while I do run other applications and do my regular work in my office while it's running.
We do have one additional question about model accuracy. Is there any way to demonstrate or to prove that the model is accurate?
Right. So the best way to do that is the same way we would do with an econometric forecasting project. Essentially, to use the model to predict the impact of sales, controlling for other things, and then to see how well the model performs. Because essentially, we are using very similar or really identical equations to an econometric forecasting model. The other approach, the only other approach that is used is with the historical data, to take the model and see how stable it is. So you take the model and take half the data, if we have enough time series to do it, and re-estimate the model coefficients and then predict the other half of the data with that model, and then do vice versa, and then calculate the predictive accuracy based upon how well it's predicting in that sense. That's usually a stability test of the model, but it can also be used, you know, is the model, is the structure of the market and the way media impacts sales, is that stable over time? That's typically what that test is used for, but it can be used to help understand the accuracy of the model as well. Okay, very good. Thank you for those questions. We will now, I think we've reached the end of our presentation, and thank you for your questions.
Thank you for attending today's Insider Series webinar. If you have any questions, feel free to email John. Our next Insider Series will be Wednesday, May 11th. Decision Analyst Clay Detloff, the Director of Insights and Innovation, will be presenting on innovation and ideation for concept development. We hope you enjoyed today's session and are looking forward to seeing you for next month's webinar. Have a wonderful rest of the day. Thank you.